If I could go back in time and talk to my 25-year-old self, knowing everything I know now after 94 years of living and 75 years of investing, what would I tell him? What strategy would I recommend for building wealth over the next 10 years? This is not a hypothetical question for me, because the answer to that question is the same answer I would give to anyone under 40 years old right now in 2026. You have something that is more valuable than money, more powerful than any investment strategy, more important than picking the right stocks. You have time, and if you use that time wisely, if you make the right decisions now and stick with them for the next 10 or 20 years, you will build wealth that will change your life and the lives of your children and grandchildren. But here is what terrifies me. Most people under 40 are making catastrophic mistakes with their financial lives, not because they are stupid or lazy, but because nobody ever taught them how wealth actually works. They think getting rich is about finding the next hot stock or the next cryptocurrency or the next big trend. They think it is about timing the market or getting lucky or having some special insight. And they waste their 20s and 30s chasing fantasies instead of building real wealth through proven strategies that have worked for over a century. Today, I am going to share the exact wealth-building strategy I would use if I were under 40 in 2026. Not vague advice, not general principles, a specific step-by-step blueprint for the next 10 years that will set you up to retire a multimillionaire. But before I give you the strategy, I need to tell you about the biggest financial mistake I ever made, because understanding this mistake will help you understand why the strategy I am about to share is so powerful. It was 1942. I was 11 years old. I had saved $114.75 from delivering newspapers and selling golf balls and doing odd jobs. That was real money for an 11-year-old during World War II. I was obsessed with investing. I read everything I could find about stocks. I studied charts. I analyzed companies. I thought I was a genius. So I took my $114.75 and I bought 3 shares of Citi's Service Preferred stock at $38.25 per share. I was so proud. I was an investor. I owned stocks. I was on my way to being rich. Then the stock immediately dropped to $27. I had lost almost 30% of my money. I was terrified. I held on, and when it recovered to $40, I sold. I made a small profit of $5 and took my money and ran. I felt relieved. I felt smart for not losing money. Then I watched that stock climb to $200 per share. If I had just held on, my $114 would have become over $600. I had missed out on a huge gain because I was impatient, because I was focused on short-term price movements instead of long-term value. That experience taught me the most important lesson of my entire investment career. Time is your greatest asset. Patience is your greatest skill. And the biggest mistake you can make is selling too early because you are scared or impatient or chasing something else that looks more exciting. This lesson is even more important for people under 40 today than it was when I was 11, because you have something I did not have. You have decades of compounding ahead of you. And compounding is the most powerful force in finance. Let me show you what I mean. If you are 25 years old and you invest $10,000 today and earn an average of 10% per year, which is what the stock market has historically returned, how much will you have at 65? Most people guess somewhere between $50,000 and $100,000. The actual answer is $452,000. 10,000 becomes 452,000. Just by sitting there for 40 years earning 10%, you do not trade it. You do not time the market. You just leave it alone and let it compound. Now, what if instead of a one-time $10,000 investment, you invest $500 per month for 40 years? Most people guess you would have maybe $300,000 or $400,000. The actual answer is $3.1 million. You invested $240,000 total, $500 per month for 40 years, and it grew to over $3 million. That is the power of time and compounding. And this is why I get so frustrated when I see people in their 20s and 30s trying to get rich quick. Day trading, crypto speculation, Meme stocks, options trading, they are wasting the most valuable asset they have, which is time. They are gambling when they should be investing. Now, let me give you the specific strategy. This is what I would do if I were 25 or 30 or 35 years old in 2026 with a 10-year wealth building horizon from now until 2036. The strategy has 5 components. Each one is critical. You cannot skip steps. You cannot take shortcuts. But if you follow all 5 components with discipline, you will build more wealth than 95% of people. Component 1 is maximize your earning power. This is not an investment strategy. This is a career and skills strategy. And it is the foundation of everything else. Because here is a truth that nobody wants to hear. You cannot invest your way to wealth if you are not earning enough money to invest. If you are making $35,000 per year and barely covering your expenses, it does not matter how good your investment strategy is. You do not have money to invest. But if you are making $80,000 or $100,000 or $150,000 per year and living on half of it, you can invest $40,000 or $50,000 or $75,000 per year. And that changes everything. So the first priority for anyone under 40 is to maximize your earning power over the next 10 years. Not to maximize your investment returns, to maximize your income. How do you do this? By investing in yourself, by building valuable skills, by becoming excellent at something that the market rewards. When I was in my 20s, I was not focused on finding the perfect stock. I was focused on learning everything I could about business and investing. I read 500 to 1,000 pages per day. I studied the annual reports of every company I could find. I took courses. I learned from mentors like Ben Graham. I invested tens of thousands of hours in building my knowledge and skills. That investment in myself paid off far more than any stock I could have bought because those skills allowed me to earn money, to understand businesses, to make better decisions for the rest of my life. For you, investing in yourself might mean learning to code. It might mean getting certifications in your field. It might mean starting a side business. It might mean becoming an expert in sales or marketing or data analysis or project management. Whatever it is, the goal is to become so good at something valuable that people will pay you well for it. Here is the math. If you invest 10,000 hours over 5 years becoming excellent at a high-value skill, and that skill increases your income from $50,000 to $100,000 per year, you have just increased your income by $50,000 per year. Over 20 years, that is an extra $1 million in earnings. That is a better return than almost any investment you could make. And the best part is, increasing your earning power and investing are not mutually exclusive. You can do both. In fact, you should do both. But earning power comes first because it funds everything else. Component 2 is live on 50% of your income and invest the rest. This is where most people fail. They increase their income, but they also increase their spending. They get a raise and immediately upgrade their apartment, buy a nicer car, go on more expensive vacations. This is called lifestyle inflation, and it destroys wealth. I have lived in the same house in Omaha that I bought in 1958 for $31,500. I drive a modest car. I do not own a yacht or a private jet, though Berkshire has a jet that I use for business. I do not wear expensive clothes or collect art or buy luxury goods. People think this is strange for someone with my wealth. But here is what they do not understand. I do not get happiness from buying expensive things. I get happiness from having freedom, from doing work I love, from spending time with people I care about, from watching my wealth compound over decades. All the expensive consumption in the world cannot buy those things. In fact, expensive consumption prevents you from having those things because it keeps you trapped working for money instead of having money work for you. If you are under 40 and making $60,000 per year, your goal should be to live on $30,000 and invest $30,000. If you are making $100,000, live on $50,000 and invest $50,000. I know what you are thinking. Warren, I cannot live on half my income. My rent is too high. I have student loans. I have car payments. Life is expensive. I understand, and I am not unsympathetic. But here is the hard truth. If you cannot find a way to live on less than you earn, You will never build wealth. You will spend your entire life working for money. You will be a slave to your paycheck. The key is to make conscious choices about what matters and what does not. Do you need to live in the most expensive neighborhood in your city? Or could you live somewhere cheaper and invest the difference? Do you need a new car with a $500 per month payment? Or could you drive a reliable used car and invest that $500 per month? Do you need to eat out 5 times per week? Or could you cook at home and invest the savings? These choices add up. If you reduce your spending by $1,000 per month and invest it instead at 10% annual returns, you will have over $200,000 in 10 years. From just that $1,000 per month, in 20 years, you will have over $750,000. In 30 years, over $2.2 million. $1,000 per month in spending cuts, sustained over time, is the difference between retiring comfortable and retiring wealthy. Now, I am not saying you should live like a monk. I am not saying you should never enjoy your money. What I am saying is be intentional. Spend money on things that genuinely improve your life. Cut ruthlessly on things that do not matter, and invest the difference. Component 3 is invest 100% in low-cost stock index funds until you have $100,000. This might surprise you coming from me. I built my career and my fortune picking individual stocks. I spend my days analyzing businesses and finding undervalued companies. But if I were starting over at 25 with limited capital, I would not try to replicate what I did. I would do something much simpler. I would invest everything in a low-cost S&P 500 index fund. Why? Because picking stocks successfully requires knowledge, skill, time, and temperament that most people do not have. It requires reading hundreds of annual reports. It requires understanding accounting and business models and competitive dynamics. It requires the emotional discipline to buy when everyone is selling and hold when everyone is panicking. Most people cannot do this. And even if you can do it, the time investment required might be better spent on building your career and increasing your earning power. But an index fund requires no special knowledge, no analysis, no time. You just buy and hold. And the results are excellent. Over the past 50 years, the S&P 500 has returned about 10% annually. That beats 90% of professional investors. It beats almost everyone who tries to pick stocks. So until you have accumulated at least $100,000, keep it simple. Every month, take whatever money you can invest and buy more shares of an S&P 500 index fund. Do not try to time the market. Do not wait for a dip. Do not get clever. Just buy consistently, month after month. When the market goes up, you buy. When the market crashes, you buy. When everyone is euphoric, you buy. When everyone is panicking, you buy. You never stop buying. This is called dollar cost averaging. And it is one of the most powerful wealth building techniques that exists. Because when you buy consistently, regardless of price, you end up buying more shares when prices are low and fewer shares when prices are high. Over time, this smooths out your average cost and removes the impossible task of trying to time the market. Let me show you the math. If you invest $1,000 per month in an S&P 500 index fund starting at age 25, earning the historical average of 10% per year, you will have $100,000 by age 31. 6 years, $100,000. From there, the compounding accelerates. By 35, you have $240,000. By 40, you have $500,000. By 50, you have $1.5 million. By 60, over $3 million. All from investing $1,000 per month and leaving it alone. No trading, no stock picking, no market timing, just consistent monthly investing in an index fund. Component 4 is once you reach $100,000, shift to a dividend-focused stock portfolio. This is where the strategy changes. Once you have accumulated $100,000 through index fund investing, you have built a foundation. You have proven you can save consistently. You have experienced market volatility and held through it. You have time invested learning how markets work. Now you can shift to a more sophisticated approach that will accelerate your wealth building and eventually provide passive income. This is where you start buying individual dividend-paying stocks instead of just index funds. Why the shift? Because at $100,000, individual stock positions become meaningful. If you buy $10,000 of a stock and it doubles, you made $10,000. That is significant. Below $100,000, individual positions are too small to matter much. But at $100,000 above, individual stocks can make a real difference. And dividend-paying stocks have special advantages for wealth building. First, dividends provide cash flow that you can reinvest to buy more shares. This accelerates compounding. Second, companies that pay consistent dividends tend to be more stable and less volatile than growth stocks.
They are mature businesses with proven business models. Third, dividends provide a return even when stock prices are flat or down. If you own a stock yielding 3%,
you are getting that 3% regardless of whether the stock price goes up or down. Fourth, dividends grow over time. The best dividend-paying companies increase their dividends every year. This means your income grows, which protects you from inflation. And fifth, focusing on dividends forces you to buy quality companies. Companies that pay dividends have to generate real cash flow. They cannot fake it with accounting tricks. Here are the types of stocks I would buy if I were building a dividend portfolio in my 30s. Coca-Cola, global beverage company, pays a dividend that has increased for over 60 years, yields about 3%. Procter & Gamble, consumer products, another 60-plus year dividend growth streak, yields about 2.5%. Johnson & Johnson.
Healthcare and consumer products, over 60 years of dividend growth, yields about 3%. Visa and MasterCard, payment networks, growing dividends,
yields about 1%, but strong capital appreciation potential. Microsoft, technology, but mature and stable, growing dividend, yields about 1%. Home Depot, home improvement, retail, growing dividend, yields about 2.5%. Costco, warehouse retail, growing dividend, yields about 1%, but excellent business quality. Berkshire Hathaway, my own company, we do not pay a dividend, but we reinvest earnings at high rates of return. These are companies that will be around in 20 or 30 years. They have durable competitive advantages. They generate consistent cash flow. They return cash to shareholders through dividends and buybacks. If you build a portfolio of 10 to 15 companies like this, reinvest the dividends, and hold for 20 or 30 years, you will build substantial wealth. Here is the strategy. From age 31 to 40, continue investing $1,000 per month or whatever you can afford. But instead of buying index funds, use that money to buy shares of dividend-paying stocks. Buy one new position per quarter. Research companies, understand their businesses, buy when the price is reasonable. Focus on quality over quantity. 10 really good companies are better than 50 mediocre ones. Reinvest all dividends automatically to buy more shares. Watch your dividend income grow year after year. By 40, if you have been investing $1,000 per month and reinvesting dividends, you should have $400,000 to $500,000. And that portfolio is generating $15,000 to $20,000 per year in dividend income. That dividend income is automatically being reinvested, buying more shares, which generates more dividends, creating a compounding loop. Component 5 is avoid these 5 wealth destroyers. This is what not to do, because avoiding mistakes is just as important as making good decisions. Wealth destroyer 1 is consumer debt, credit cards, personal loans, car loans, any debt used to buy things that depreciate. This debt typically charges 10 to 20% interest. You cannot build wealth if you are paying 20% interest on consumer debt while trying to earn 10% on investments. The math does not work. If you have consumer debt, pay it off before you invest. The return on paying off a 20% credit card is 20% guaranteed. You cannot get that anywhere else. The only debt I would consider acceptable is a mortgage on a home you can afford, because real estate can appreciate and mortgage interest is relatively low. And student loans, if they are for education, that increases your earning power. But credit card debt, car loans, personal loans, these destroy wealth. Avoid them completely. Wealth destroyer 2 is lifestyle inflation. I already mentioned this, but it is worth repeating. Every time you get a raise, your instinct will be to increase your spending. Resist this. When you get a raise, keep your spending the same and invest the entire raise. If you make $60,000 and get a raise to $70,000, keep living on your current budget and invest the extra $10,000 per year. This discipline is what separates people who build wealth from people who earn a lot but stay broke. Wealth Destroyer 3 is trying to get rich quick. Day trading, options, cryptocurrency speculation, penny stocks, following hot tips, anything that promises huge returns in a short time. These are all forms of gambling dressed up as investing. Yes, some people get lucky. For every person who makes money day trading, there are 20 who lose money. The house always wins in the long run. And the time you waste trying to get rich quick is time you could have spent building real wealth through proven methods. I have never met anyone who got rich quick and stayed rich. Wealth Destroyer 4 is paying high fees to financial advisors and mutual funds. Many financial advisors charge 1 to 2% of assets per year. Many mutual funds charge similar fees. Over 30 or 40 years, these fees compound and can cost you hundreds of thousands or millions of dollars. A 1% fee sounds small, but on a $1 million portfolio, that is $10,000 per year, every year, for doing what you could do yourself by buying index funds or dividend stocks. If you are going to use an advisor, use a fee-only fiduciary who charges by the hour for advice, not a percentage of assets. And avoid actively managed mutual funds. Their fees are too high and they usually underperform index funds. Wealth Destroyer 5 is not having an emergency fund. Life happens. You lose your job. Your car breaks down. You have medical expenses. If you do not have an emergency fund, you will be forced to sell investments at the worst possible time or go into debt. Keep 3 to 6 months of living expenses in a high-yield savings account. This is your emergency fund. Do not invest it, do not touch it unless you have a real emergency. This fund gives you the flexibility to stay invested during market crashes, to take career risks, to handle life surprises without derailing your wealth building. Now let me show you what this strategy looks like over 10 years for someone who follows it faithfully. You are 28 years old in 2026. You earn $70,000 per year. You commit to living on 50%, which is $35,000, and investing $35,000 per year, which is about $3,000 per month. You already have $20,000 saved in an index fund. Year 1, 2026 to 2027. You invest $3,000 per month in an S&P 500 index fund. The market returns 8%. By the end of year 1, you have $58,000. Year 2, 2027 to 2028. You continue investing $3,000 per month. The market returns 12%, a good year. You now have $105,000. You have crossed the $100,000 threshold. Year 3, 2028 to 2029. You shift strategies. You keep $50,000 in the index fund for stability. Use the other $55,000 to start building a dividend stock portfolio. You buy 5 stocks, about $11,000 in each. Coca-Cola, Procter & Gamble, Johnson & Johnson, Visa, Microsoft. You continue investing $3,000 per month, now buying additional shares of these dividend stocks and adding new positions. The market returns 10%. Your portfolio is now worth $150,000. Year 4, 2029 to 2030. You continue the strategy, adding to existing positions, starting new positions in Home Depot and Costco. The market returns 6%, a slower year. Your portfolio grows to $200,000. Year 5, 2030 to 2031. You are now earning $90,000 per year after getting raises. You still live on $35,000 and now invest $55,000 per year, about $4,600 per month. The market crashes 20%. This is scary, but you keep investing. You are buying stocks at much cheaper prices. Your portfolio declines to $190,000 despite your contributions. Year 6, 2031 to 2032. The market recovers up 30%. This is why you kept investing during the crash. Your portfolio jumps to $300,000. Year 7, 2032 to 2033. Steady growth. The market returns 9%. You continue investing. portfolio at 400,000. Year 8, 2033 to 2034, the market returns 11%. Portfolio at 540,000. Year 9, 2034 to 2035, the market returns 7%. Portfolio at 660,000. Year 10, 2035 to 2036, the market returns 10%. Portfolio at $800,000. At 38 years old, you have $800,000. Your dividend income from your stock portfolio is about $20,000 per year and growing. If you keep going, if you do not touch this money and keep adding to it, you will be a multimillionaire by 50 and will have over $5 million by 60. You can retire early if you want, or you can keep working because you love what you do, not because you need the money. This is financial freedom. This is what wealth building looks like. Now, I know some of you are thinking this sounds great, but you cannot invest $3,000 per month. You can only invest $500 or $1,000. That is fine. The strategy still works. It just takes longer. If you invest $1,000 per month instead of $3,000, you will have about $300,000 at the end of 10 years instead of $800,000. Still an excellent outcome. The exact dollar amounts matter less than the discipline. Consistent investing, living below your means, avoiding debt, avoiding get-rich-quick schemes, staying invested through volatility. If you do those things, you will build wealth. Let me also address some objections and questions I always hear from people under 40. Objection 1, the stock market is too risky. I could lose everything. No, you cannot lose everything by investing in diversified index funds or quality dividend stocks. Yes, the market will crash. It always does. In your investing lifetime, you will probably see 3 or 4 major crashes where the market drops 30 to 50%. This is scary. This is painful. But the market always recovers, always. In 100 years of stock market history, every single crash has been followed by recovery to new highs. If you stay invested, if you keep buying during the crashes, you will be fine. The only way to lose everything is to panic and sell at the bottom, or to invest in individual speculative stocks that go bankrupt. This is why we stick with index funds or quality dividend stocks. Objection 2, I should wait for a crash to invest. The market is too high right now. This is the most expensive mistake people make, waiting for the perfect time. I have been hearing this my entire life. In the 1980s, people said the market was too high. It went up. In the 1990s, people said the market was too high. It went up. In the 2000s, people said the market was too high. It went up. Yes, there were crashes along the way, but the people who kept investing did far better than the people who sat in cash waiting for crashes. Time in the market beats timing the market. Start investing now with whatever you have. Objection 3, I have student loans. Should I pay those off first or invest? This depends on the interest rate. If your student loans are at 7% or higher, pay them off first. The guaranteed return from eliminating 7% debt is better than the uncertain return from investing. If your student loans are at 4% or lower, you can invest while making minimum payments. At 4%, your investment returns will likely exceed your borrowing costs. If your loans are between 4 and 7%, split the difference. Pay extra on the loans while also investing something. Objection 4, I need to save for a house down payment. Should I invest that money or keep it in savings? If you are planning to buy a house in the next 2 or 3 years, keep the down payment money in a high-yield savings account, not in stocks. You cannot afford the risk of a market crash right before you need the money. But do not let saving for a house stop you from investing for retirement. Do both. Save for the house down payment in a savings account. Invest for retirement in stocks. Objection 5, what about inflation? Will my money lose value? This is exactly why you need to invest in stocks. Stocks are ownership of businesses. Businesses can raise prices to keep up with inflation. Over long periods, stocks have beaten inflation by 6 to 7% per year. Cash loses value to inflation. Stocks protect you from inflation. Objection 6, what if I need the money before retirement? This is what the emergency fund is for. You keep 3 to 6 months expenses in cash for emergencies. Everything else gets invested for the long term. If you are saving for something specific in the next 5 years, keep that money in savings, not stocks. but your retirement and wealth building money stays invested no matter what. Let me close with a story about the power of starting early. There were two friends I knew years ago. Both started investing at age 25. Friend A invested $5,000 per year for 10 years, from 25 to 35, then stopped completely and never invested another dollar. Friend B waited until 35 to start investing, then invested $5,000 per year from 35 until 65, 30 years of contributions. Who ended up with more money at 65? Most people guess friend B because they invested for 30 years instead of 10, but friend A ended up with more, much more. Friend A invested $50,000 total over 10 years. At 10% annual returns that grew to over $1 million by age 65, friend B invested $150,000 total over 30 years. At 10% annual returns that grew to $900,000 by age 65. Friend A invested 1/3 as much money but ended up with more because they started 10 years earlier. Those extra 10 years of compounding made all the difference. This is why I am so passionate about getting people under 40 to start investing now. Not next year, not when they're making more money, not when the market crashes, now. Even if you can only invest $100 per month, even if it feels like a tiny amount, start now and let time work for you. You have the most valuable asset that exists. You have decades of compounding ahead of you. Do not waste it.